So we're going to be discussing cap tables. The way I structure this is basically I will have a very, very quick presentation, about 15 minutes, and then we'll jump onto the Excel, and then we'll be able to illustrate, hopefully, a lot of the things that I would like to cover on the Excel. So we can do some calculations, and we can sort of do a mock-up cap table. You can ask questions, and I can try to address them. Hopefully, we will cover all your questions and doubts. Cap tables can get complicated, but they don't need to be. My recommendation is always, build your own. It's an interesting exercise, and you can see where the company is going, and include some sort of the upside scenarios, and count the millions basically at exit. So it's always an interesting exercise. So let's go to it. Quick intro, in case somebody at the call hasn't been in any of my webinars so far. As I said, quick intro to Whitepeak. Cap tables, a few the definition and objectives of the cap table. A few concepts. Apologies, concepts is not written correctly. And then finally, we'll jump onto an example, and we can discuss some tips, how to build your cap table, etc. Okay. So we at Whitepeak Partners are a European-based advisory firm. We're based in Spain and in the UK, and help European-based tech companies with what we call liquidity events. You can see there, liquidity events meaning mostly M&A and capital raising situations. We also engage in secondary placement sometimes, but that's sort of the bulk of what we do. We operate across primarily companies based in UK and Spain, but we have also worked with companies in Germany, Israel, and other places in Europe. And in terms of investors, we do have a wide network. We know pretty much anybody who can invest 2-3 million onwards in Europe, and we have a wide network also in the US, especially in the East Coast, and which is more relevant for European companies, really, at sort of earlier stage. And also increasingly, we see more and more investors from Asia. And again, this includes not just venture capital investors, but also corporate investors, which are very active for the past few years, investing either from purposely sort of special purpose vehicles or sort of venture arms, the so-called corporate venture capital arms or firms, or directly from their balance sheet, right? So these are some of the names of companies that we've been working with. They're all on the website. Just a few words on myself. I've been with Whitepeak. I co-founded Whitepeak with my partners about 4 years ago. And prior to that, I spent almost 10 years in investment banking, primarily at Merrill Lynch in London. And that was after my MBA at London Business School. And before my MBA, I worked as an engineer in R&D for Mercedes-Benz in Germany. Good, enough intro. So let's jump in, okay? So cap table. What is a cap table? I mean, I suppose you all are familiar with what it is, but cap table stands for capitalization table. So basically, it's a summary of who owns what, right? It's a summary of the economical rights of the company, of the capital of the company. It helps you. I mean, it has several purposes. It does help you target the right kind of investors, and what I mean by that is that you can because you can build all the scenarios in terms of valuation and stakes, etc. It helps you sort of understand what kind of investor would fall or would fit within a specific sort of investment round. as I just said, you can actually build a lot of different scenarios, and I encourage you all to do it. Scenarios in terms of valuation and the dilution in different rounds. We'll do an example later, so you will see exactly what I mean by that. Again, and also it's a help also towards aligning incentives for all stakeholders, because it will give you the visibility as to who owns what. You can factor in special items in the term sheet, or in the articles of association of the shareholders agreement of the company regarding liquidation preference, ratchet structures if you have one, etc. So you can embed all those into the cap table, and see what that really means in terms of, what happens if you sell the company for 100 million, who gets what? Because at some point after several rounds, it gets a bit complicated. It's not as straightforward as, hey, I'm the founder, I own 30%, so I'm gonna get 30% of the company, or 30% of the 100 million at exit. Not quite. Ideally, yes, but it's not always the case. So we can discuss that. The kind of things that you're gonna be bringing in or building into the somehow into the cap table are liquidation preferences, quite clearly, stock options, very important when you factor those in, pre-round, post-round. We can see what that means later. Ratchet structures, if you have one, you don't need to have one, but in our earlier discussion about valuation, one of the things that we were saying is that if you are far away from, if your valuation expectation in an investment round is a bit far from what you are getting offered, one way around it could be to introduce what's called the ratchet structure, which means that based on certain milestones and given a certain outcome, you can redistribute proceeds in a different way. For example, you get an investor to come in investing 1 million in exchange for 30%, which could be a lot. Maybe you were thinking more like 20-25%, but the investor tells you, no, I want to invest 1 million for 30% because there's too much risk and I'm not convinced, and you haven't convinced me enough. Okay, so you can basically tell him, you coming with 1 million for 30%, but the moment you hit 3 times your money at exit, or 5 times your money at exit, or whatever, I'm gonna get a chunk of your proceeds, basically. So that basically means that if things go so, average, the investor is gonna be able to get that 30% that he owns, right, of the outcome. But if things go really well, because you are convinced that things are gonna go well, and therefore your valuation is super cheap and a bit punitive for me. So if things go really well, why don't you share a little bit of your outcome at exit, so that I can and what that basically means is that retroactively, it will look as if he entered not with 30%, but maybe with 27% or 25%, right? So you are improving your position as a founder. It's a compromise solution. It doesn't have to be super complex, but it is not super straightforward. So, so just wanted to illustrate that. I don't think we're gonna do that in any of the examples, but if you have questions or you wanna find out more about it, just ask. Conversion of debt into equity. I mean, I think you're all familiar with convertible notes, or at least you have heard of them. It basically means that you're getting a loan that can be converted based on, sometimes it's at the discretion of the note holder, or it could be based on certain milestones or whatever, and it will be converted into equity. We will discuss later why that is and what function it has. The cap table will give you a tool to deal with that and see exactly what that means. And we can look at how you can account for those shares in the cap table. Okay. Other things it will help you with is also calculating the preemption rights, how many shares you need to allocate in a new round for existing shareholders. Are you sorry, I can't ask questions to everyone because we are remotely, but it's so much easier when we are all in the same round. But I'm gonna explain in any case, just in case, what a preemption right is before before going any further. So a preemption right is basically the right for existing shareholders to buy shares in a new capital increase in order to maintain their position. So if you allow this preemption right on a pro rata basis, it means that if I own 10% of the business and you're raising new money, new capital, I have the right, and you cannot take that away from me. If that's written in the shareholders agreement, I have the right to invest 10% of whatever money you're raising at the same terms that you are negotiating with the lead investor. I'm not getting better terms, but I have the right to take 10% of the round on a pro rata basis. Okay, and this is a right that is very, very, very common. It's not harmful for the founder. It's not harmful. I mean, it's standard, and it gives investors a little bit of protection against dilution, right? Because if they want to continue, investing, they can do so and maintain their stake. If they want to invest more than the pro rata, that could be a problem, because if the new investor wants to take the entire round, it will allow for the pro rata for the existing investors, but it may not allow existing investors to invest more. This is sometimes the case, but it's not too frequent, because usually new investors like when existing investors put new money, because it sends a very positive message. It means that existing investors who know the company much better than the new investor are actually committed. On the contrary, if everybody has preemption rights on a pro rata basis and nobody is investing in the new round, that's not great. So the new investor may get a little bit suspicious. If they are business angels and so on, okay, that's understandable. But if you have a venture capital fund in your cap table and they're not contributing at least to the pro rata using the preemption rights to the new round, in the new round, that may be perceived negatively. Okay, so I guess that gives you a little bit of the context.
Unai, one quick question.
Yeah.
Is preemption rights, and just forgive me if I didn't understand or I didn't catch it. But do the investors then buy based on the current round share price, or would it be on the next one, based on that valuation and that share price?
No. It will be based on the new price.
New one, okay.
Same conditions. So they're not getting an advantage. They're just getting the right to be part of the round. So the idea is that if I own 10% of the company and there is a new round, let's say you want to raise 2 million in exchange for 20%. That means that if I don't put any money, my 10% is going to go down to 20%, right? There's going to be a 20% dilution for everyone, including my stake. So I may actually end up with 10% will become 8%. But if I have a preemption right on a pro rata basis, I can basically put in 10% of the new money. And if I put in 10% of the new round, my 10% will not go down to 8%, will stay 10%. Okay? And that's the whole logic. As an investor, I want to be able to maintain but obviously it's not going to be for free. I mean, it's going to be, I'm going to have to put in some money. In fact, some investors who I mean, and this is not standard, but it can happen that they may want to have more than their pro rata. So basically, sometimes that's called super pro rata. So basically, I want twice my pro rata as a preemption right. That means that if I own 10%, I want the right to invest up to 20% in the new round at my discretion. And this is a right that in the investment round, I can put it in writing, and in the next round, I can use it because it's my right. Nobody can take that away from me if it's written in the shareholders agreement, right? Super pro ratas are, you can find them. They're not, but it's not the standard. The standard is pro rata. And then the last point, the cap table will also help you understand where the political weight is, because it can get a little bit complicated because you all start with ordinary shares. Ordinary shares are just ordinary shares or common shares. I mean, different names for the same thing. But as you go into the next round and the next round and the next round, normally, and this is also a legal thing, at every round, the name of the shares changes sometimes. So ordinary shares. So in the seed round, for example, the shares that are created for the seed round may be called Class A shares or Class C shares or whatever. Normally they use letters. Don't confuse the letters with the series. So Class A shares doesn't mean Series A. A follows ordinary, B follows A, and C follows B, and that's all. That's all it is. So don't read anything else into it. And that is because at subsequent financing rounds, every new share at each round may carry different rights to the previous round. For example, preemption rights. Maybe the ordinary shares may not have preemption rights, and the Class A shares may have preemption rights, and so on. And when those shares have a specific right called liquidity preference, which we will discuss in a minute, those shares are called preferred shares. They're called preferred shares because they have a liquidity preference right. We'll discuss what that means. Well, I mean, it's actually here on the list. It's a downside protection for investors. We'll see some examples of that. Okay. So if you have a cap table, you can calculate the number of shares, and I also encourage you to calculate the number of total shares and also the breakdown of each type of share. If you have several types, if you have ordinary, Class A, Class B. Calculate at every stage, you calculate the number of shares for each class, because sometimes, there will be different voting majorities most likely in the shareholders agreement for certain decisions. So when you are at the initial stage and you only have ordinary shares, the world is very simple, right? I own 20%. My other co-founder I own 50%, my co-founder owns 50%, and then you start allowing people in, and the cap table starts getting more complicated. And when you get new classes of shares from investors, from venture capital investors, very specifically, they will demand certain rights. They will ask you, I want liquidation preference, I want preemption rights, and I also want to have veto power over certain decisions. Okay, we're getting into a different terrain, but I think it's really important to clarify this, because what happens with veto rights is that, and I really encourage you never to give nominal veto rights. So no investor by himself or herself, should have a veto right. You can basically dilute the veto rights by seeking consensus among investors to veto a decision. For example, you're raising 2 million from an investor, and the investor says, this is a lot of money, I'm a professional investor, I want to keep a little bit of control over the business, so I want a board seat, and here's a list of things that you cannot decide unless I say so, unless I vote favorably. Don't grant that veto power nominally to that investor. What you can say is, hey, why don't we say that we need a majority of all investors coming into this round in order to make that decision. So you're basically seeking a little bit of consensus to exercise that veto. How do you do that? You do the maths. You calculate how much he weighs in that class of shares, and you can actually specify in the term sheet and in the shareholders agreement. You need 2/3 of the preference A shares in order to veto this decision, for example, right? That means that from all the investors coming into the preferred A round with that class of shares, you're gonna need 2/3 to exercise that veto. If this new investor has 50% of those, meaning he's only contributing with half of the round, he's not gonna be able to block you alone. In order to block you in that decision, he's gonna need more people to agree to him. So these are all reasonable demands, reasonable compromises. And that is why it's important to have a cap table that works, that it's well built, so that you can basically calculate thoroughly all this balance of power and voting and majorities, etc. Okay? Good. So let's jump a few minutes on some concepts that I need you to be familiar with, and then we'll jump onto the Excel, okay? Pre-money versus post-money valuation. I guess everybody is familiar with this, but in case somebody is doubting, pre-money is called pre-money because it's basically the valuation before the money comes in, okay? So if you are raising, 2 million, usually when you talk about valuation in investment rounds, we generally discuss, people generally refer to pre-money valuation. Okay, so pre-money valuation is the company as it is now. The moment I put 2 million in a capital raise, it's a different company because you have 2 million more. So the day after or the minute after you get those 2 million, the valuation that you are at exactly after you sign the papers and you get the 2 million on your bank account, then your valuation is 2 million higher, and that's the post-money valuation. So you take the pre-money valuation, you add 2 million, and that's the post-money valuation in this case. Okay, and then there is share price. Share price is pre-money, or well, actually, the share price in that investment round, it will be 1. All shares are priced at the same price, right? What you do is that when you calculate the share price, the denominator and denominator will change. So basically, if you use the pre-money to calculate the share price, you take the pre-money valuation and you divide it by the number of shares before the capital increase. Then you take the share price, then now calculate the same share price using the post-money valuation. What would you do? You take the post-money valuation and you divide it by the total shares after the money comes in. The share price in both cases will be exactly the same. And this relationship is what you use to calculate the dilution. Okay? So if you want to know, I'm investing, I want to raise 5 million at 10 million pre-money valuation, how much percentage do I have to give to the investor? Well, you can take the 10 million divided by the existing shares, etc., or easier, because there's this relationship, you can take the post-money valuation, which is 10 million pre-money plus 5 million, 15. And 5 million out of 5 million, which is the new money that is coming in, as a proportion of the total value of the company, which is 15, comes down to 1/3. Okay, so 1/3 would be the dilution in this case. Okay, and the share price is calculated using either the pre-money or the post-money and the number of shares pre or post-money, as I explained earlier, but it's the same share price. Okay, we'll see numerical examples later. Common shares versus preferred. We already covered that. And different classes of shares, we already covered that as well. So I'm not gonna get into that. Pro rata and super pro rata, we have also covered. So I think we don't need to get into that either. Share majorities, actually, we have covered that as well. the voting by different classes of shares in different situations, okay? Fully diluted versus not fully diluted. Okay. Fully diluted is the percentage. So whenever you refer to a stake in the company, or sometimes also the valuation and so on, you specify whether you are calculating it fully diluted or not fully diluted. The difference between fully diluted or not fully diluted is the stock options, okay? Stock options or phantom shares. We'll see the difference in a minute. But basically, when you don't take into account any stock options, the calculations you make are not fully diluted because you're not taking into account the dilution from stock options, okay? As a reminder, a stock option is basically an option to buy shares at a given price, okay? It's usually a reward, and it's usually a tool used to incentivize employees and key management or key employees, okay? So for example, if you give me a 2% stock option package with a specific strike price, maybe the strike price is 0 actually, but there could be a different strike price. That means that the moment I exercise the stock option, I'm gonna have to pay the strike price. If it's 0, it's for free. If it's not 0, I'm gonna have to pay something. But the thing is that I will exercise the stock option at a liquidation event. So when the company is going to be sold and everybody's gonna make money, the founder is gonna sell the company, the investors are gonna sell the shares, and the stock option holders will then exercise the stock options and claim shares on the company. That means that if the company had 1 million shares, but 100,000 stock options, it means that the proceeds at the end are not going to be distributed among 1 million shares. They're going to be distributed among 1 million shares plus 100,000 shares, because the people holding the 100,000 stock options will exercise the right to buy shares, and the company is going to have to issue new shares to satisfy those stock options. That's how it works. The moment you create a pool of ESOPs, as they are called, the company acquires the liability to create new shares to satisfy that stock option demand. That means dilution, okay? Now, one thing to consider is that during all that time that employees are holding stock options, the stock options per se don't have any voting rights. So so the stock option is basically an economical right, but has no political power. There's no political right whatsoever. So that's exactly what you want stock options for, right? You want to have employees happy. Here's a few stock options. You're going to be able to monetize that in the future if things go well. So you're going to make sure that things actually go well, because you're going to make money out of it if they do go well, right? Stock options have vesting periods, etc., but we're not going to get into that. That's a discussion for another time. Okay. Difference to phantom shares. It's the same concept, but it's slightly different. Phantom shares are not stock options in the sense that it's not a right or an option to buy shares. It's basically just a recognition of the economical right. And there's a subtle difference, and it's a tax difference. In certain countries, stock options by themselves have a value, right? And in some jurisdictions, that value has to be declared to the tax authorities, and you have to pay taxes on it. In Spain, for example, if you have stock options, every year you need to value those stock options. And there's a lot of methods, financial methods, to calculate the value of stock options with very complicated formulas. So you basically have to value those stock options because there is an underlying value there, because it's an option to buy something that already has a value today, and the value may increase in the future, and there's certain probabilities, etc. So, and because you're getting something that has financial value, you need to pay taxes on that. In phantom shares, you don't, because you're not getting anything. You're just getting a piece of paper that says that when the company sells, you're gonna get some money. And that's all you get. In both cases, you have no political rights, okay? So the main difference between one and the other is usually the fiscal treatment. In the US, stock options are fiscally well treated, as it is the case in the UK. Not so much in Spain. So people in Spain do phantom shares, but in the UK or in the US, the most the most likely ways is stock options. Is the most used tool to incentivize key employees. Convertible loan versus price round. We will see examples later, but a convertible loan, as I said earlier, is a loan that converts into equity under certain conditions. And when you do an investment round based on a convertible, there's certain peculiarities, but the most important one is that on a convertible loan, there is no valuation because there's no equity, there's no round. It's debt, right? It's a loan. But so the reference to the valuation comes from the fact that it will be converted into equity. So there will be certain clauses that specify at which valuation is going to be converted. But that valuation is usually tagged or referenced to the future valuation of the round. And that's how convertible loans can be quite practical, because if you're going to go for a big round at some point, but you need to bridge the gap to the round because you want to accelerate, you need some extra money, or the valuations you're getting for the round that you have planned is not great, you need to hit some other KPIs, you may want to raise a smaller amount of money in the form of a convertible loan in order to go after a big round later in a much better position, right? With better KPIs, with a lot of the homework done. The beauty of convertible loans is that because it's not an equity investment, you don't need to do a shareholders agreement. You don't need to engage in 3 months of due diligence and contract negotiation, etc. It's just a loan sort of contract. So there will be some due diligence, but the paperwork is as simple as, it could be as simple as 3 or 4 pages or 5 pages, establishing under which conditions I'm gonna get my money back because it's a loan, so you have to repay it, or under which conditions I'm going to convert when the round happens, right? And when the round happens, I will convert not at the same valuation. Why? Because I'm giving you the money before the round. So I'm taking on more risk than the upcoming investors. So if you're very, very, very close to the round and you basically almost have a term sheet and so on, the convertible that comes before will come at a small discount. It could be as little as 5%, but usually the discount will be more like 20%, okay? 20, even 25 or more, depending on the time lag between the convertible coming in and the planned round. So as a convertible, as the investor in the convertible note, I'm taking on more risk. So I'm also going to add something else, which is also standard in convertible loans. I'm going to put a cap. So I'm going to say, I'll give you 1 million. I'm going to convert into equity at a 20% discount to whatever valuation you get in the future, in the next round, as long as the round is within the next 18 months, for example. Because if the round is in the next 5 years, I'm gonna capitalize, I'm gonna convert into a much, much lower valuation, okay? Because I'm taking on a lot of risk. So 20% discount at the next valuation, but the valuation cannot be higher than a certain value, and that's called cap, okay? And what's basically saying is downside protection, right? I don't know how things are gonna go, but I'm taking on a lot of risk. I don't want to be in a situation where I give you the money at a 20% discount, and then tomorrow or in 3 months' time, you strike a deal with 3 big companies, and your valuation multiplies by 3, and then I have to convert at a much higher valuation. That's not fair because I didn't know about those contracts when I invested, right? I'm taking on a lot of risk. So that's why you usually put a cap. Primary investment, secondary investment. Again, I don't have the possibility to ask and ask you to raise your hands if you know the difference, but so I'm going to explain it. When we talk about primary and secondary, what we mean is that primary means new shares, secondary means existing shares. That's all you need to remember. Secondary, like a secondary market or a second-hand car, right? Secondary investment or secondary transaction is when shares change hands, right? So some existing investors sell some of the shares to new investors, for example. That's a secondary transaction. Primary means we create new shares, and the difference is that the money you raise for primary investment goes to the company. The money that you raise or somebody invests in a secondary transaction, that money does not go to the company. It goes to the shareholders that are selling. Okay, we'll see why I put it here, because it's not infrequent that you see investment rounds that include both the primary, a major primary component, because that's why you do a capital increase, to raise new capital for the company. But sometimes you also allocate, you also allow for a secondary investment so that some investors can sell some shares, which could have a lot of advantages for the company and the founder. Okay. Last, waterfall of proceeds. I will show you an example of what that means, but it basically means that after you've built a cap table, you take the final stage of ownership, so to speak, and you apply different scenarios of exit, and you calculate, okay, how much does each of us get if I sell the company for 100, 150, 500 million, or 1 billion, or whatever, right? That's when you have to think about the stuff that we talked about earlier, like liquidation preference and other, ratchets and other type of sort of arrangements, which will determine who gets what. Okay, and it's called a waterfall because you usually put a line with the different valuation scenarios, and then for each person you can calculate as a cascade who gets what, because there is a pecking order in the proceeds. So not only you need to calculate who gets what, you also have to take into account who gets what when. Okay, because some people get the money first and other people, usually the founders, get the money last. Okay, so it's very important to understand this concept for your own sake. And then last, anti-dilution. I'll show you a couple of, I'll explain a little bit more about that, but we're not going to get into the calculations because they can be quite complex. Anti-dilution clauses are usually in the term sheet or in the shareholders agreement to protect investors in case of a down round. So if you're raising money at higher valuation and at some point you raise money at a lower valuation than the previous round, the investors that came at a higher valuation are going to be penalized because now new investors are coming at a lower valuation. So in order to compensate existing investors from that downside, there are anti-dilution clauses in the shareholders agreement, and it's absolutely standard to have those in term sheets. So if you are even at seed level or beyond, certainly you will have anti-dilution protection for new investors. Okay.
Unai, a quick question here.
Yeah.
Because a lot of our founders actually work with advisors who come in quite early, and they might say they want, a very small percentage of the company, and they will sometimes ask for anti-dilution, right, an anti-dilution clause. Is this something standard? No. Okay. Good to know, because we've heard it a couple of times, and there's always, of course, a pushback, but.
No, it's not, because and one thing with advisors is that advisor shares or advisor stock options, or however they're called, and one way to avoid that is basically stock options, because stock options don't have anti-dilution rights. So basically, you know, a small portion is a relative concept, right? I've seen some companies being relatively, I mean, quite generous with advisors and granting significant stakes. I mean, they seem small at you know, at the beginning, but the entrepreneurial journey, it can be a long one. And people who are very relevant initially, they may remain relevant, but you don't know upfront. And a year, you know, 2 years is a long time. Even 6 months can be a long time, and a lot can change in the company. You could be pivoting, you could, you know, the whole situation may change completely. So you always have to keep that in mind when you grant this kind of privileges or this kind of rights. Obviously something that advisors are gonna sort of, you know, negotiate for their own sake. But yeah, I mean, I don't dare to say, you know, a percentage, but it will be on the sort of 1.5, 2% maybe sort of range. I wouldn't go necessarily beyond that. And I would always bring in vesting schedules. Vesting means that they don't get those shares or those ESOPs right away. They will get them gradually. So you can allocate them right straight away, but they cannot access them unless certain milestones take place. And those milestones are usually based on in terms of employees, is based on permanence. So if the employee continues to be an employee in 2, 3, 4, 5 years, they will start basically vesting some of that allocation of ESOPs. In terms of advisors are not employees, so you have to be a bit more creative and find ways to make sure that they continue contributing, right? If they continue contributing and being part of the and devoting time, and sometimes it's as simple as putting time commitments, right? Because, you know, it's easy to talk and then more difficult to actually find the time to do the thing. So you don't want to be in the situation where you granted 3% to someone and 2 years later you haven't seen him for a year. The investor is asking, who's this guy in the cap table? He owns 3%. You have a CTO who owns only 1%. Like, why that discrepancy, right? So be careful with that. Good. So let's go into the examples then. Let me just share. Let's see if I can find it. Yeah. So let's go onto the I guess we have 25 minutes.
We have until 3:30 officially, so another 40 minutes maximum.
Okay, I'm gonna try and do it quickly. But yeah. So let's go into a cap table, right? And actually let's build one from scratch. Okay. So here you have a structure of a cap table. It's empty because I'm gonna formulate it now. And what we're gonna build is this scenario, okay? You have a company that had an early seed round with business angels in February 2017. They raised $250K at 2 million pre-money valuation, okay? Then they raised 750K in December 18 at 4 million pre-money valuation. And earlier this year, because you know, because of what I was saying earlier about convertible notes, they decided, let's raise 1 million because we're not quite ready for a Series A. And this 1 million, you know, we're confident we can raise it. And we're gonna use it to do all the homework and gather all the KPIs, etc., to close 4 million in September. Okay. Okay. The 4 million in September will come, let's say, 12.5 million pre-money. And then I'm going to also see what it would look like if I put 10 million at 28 million pre-money at a later stage. So this will be a next sort of Series B. So basically, this is where I am. I'm in between these two scenarios, right? I already raised the convertible. Remember, the convertible is not equity. So the investors in the convertible are not in the cap table. they are not in the shareholders agreement. Usually they have no voting rights. You may have given them some information rights so that they feel almost as investors, but they are not, okay? But they're gonna convert at this stage. When you raise the Series A, they will convert and what we call it is capitalized. They will capitalize their debt into equity, okay? So the debt will convert into equity. And that will happen in this Series A transaction as part of one thing, of the same thing, okay? So let's start populating this, okay? So what we have here is a very simple cap table with some investors that I made up. These are the founders. These are the ordinary shares, the famous ordinary shares, the initial shares. And initially there's 1.5 million. And the founders have decided from the very start, let's go allocate, let's create a pool of ESOPs, stock options, in the amount of 120,000 to incentivize new people that we're gonna need, right, in the next few years. I put them unallocated because we haven't allocated them yet. This is the starting point, okay? And this is, let's say, August 2016, okay? Now, February 17, Alpha Ventures gives you 250K, right? At, we said 2 million valuation, okay? I mean, you can change obviously the data. Maybe a word on before we progress further. Color coding. Every time you do Excel, business plan, financial model, and so on, cap tables, etc., I urge you to use a color code, color coding. I use this one. You can use any one. But basically, what I'm doing here is that I'm marking in yellow the cells, the assumption cells, so to speak, the editable cells, so that everything else will be formulated. And as long as I only change the things in yellow, everything else will still be okay. If you don't do that, imagine, this is the cap table all already done. If you don't use any color coding, now there's no way to know what's an input, what's an output, what's manually entered. And if you change something, you don't know if you're screwing the formula or not, and that can have devastating consequences, because a few months down the road, you were maybe calculating the share number wrongly, you didn't realize, and that deviation may cost you nicely, right? Because you are basically negotiating based on this, okay? This is the tool you're using to negotiate and understand what do I give to whom and how, and what does that mean for my pocket, okay? So be careful with that. Color coding, very important in anything you do okay? This is the nominal investment, okay? I want, I want 250K, okay? Now, how do I calculate the number of shares that this means? Okay, so remember pre-money, post-money, and price per share. So if the pre-money is 2 million, the post-money valuation will be the pre-money plus the money that I'm investing, right? So the post-money will be 2.25. The number of shares that I need to use as a denominator is going to be the total diluted shares. Don't take 1.5 million. You have to take 1.62 million because you have to take into account the ESOPs, okay? Because they've already been created according to this scenario, okay? So I take this, and now the price per share fully diluted will be pre-money divided by this, okay? Why do I take the pre-money? Because I'm dividing by the number of shares before the money comes in, okay? I take 2 million divided by this, and this is the share price of this transaction. This early seed investment is going to take place at 1.23 share price. Legally, when you have to put in these numbers into the term sheet and the legal documents and the contracts, usually you cannot put an endless number of decimals, okay? So what you would do is you round it to 2 decimals, because you can't get anything smaller than 1 pence or 1 cent of the dollar in this case, at least for now. I mean, you can't get any smaller part of that than that. So the share price will then be, and these rounding things are important because they can, I mean, it doesn't make, it only has small consequences, but because you're gonna bring all these numbers into a legal document, etc., it's good that you are thorough with these things, okay? So you do this, 1.23 is the price. So the number of new shares, here's the new shares that I'm going to create, is going to be 250 divided by 1.23, okay? Remember, shares cannot be divided into decimals because shares are discrete. You cannot have 0.3 shares. So you need to round this to 0. Okay, so you forget about the decimals. These are the number of shares, no decimals, you see? And now, to be very precise, the investor, the business angel is not going to give you 250 exactly. It's going to give you 203.252 thousand shares. So this number of shares multiplied by 1.23, which means he's going to give you $249.999.96. Okay. So this is the what we use as a reference, but in the legal documents, this is what he's going to give you, because again, the decimals will get lost because we can only have discrete number of shares. Okay. So we've already done the first round, as simple as that. And now all we do in the next round is do exactly the same calculation. Okay. So we said in the late seed, we're going to have 750 at 4 million pre-money. Okay. We're doubling the valuation, right? The pre-money. So Alpha is going to invest 750 at 4 million valuation. Post-money valuation would be, I think I can use this, sorry. Post-money will be 4.75. The number of shares, again, the fully diluted number of shares will be here, but we need to complete that. So basically, we forgot to complete the first table. So new share, total shares will be existing shares plus new shares, which is 0. I drag this here, and that's the number of shares. I can actually do the same with the stock options as well. And now I'm going to calculate the stake, right? So on a non-diluted basis, without considering stock options, I'm going to divide by this number of shares. Okay. And this is going to be obviously, 100%. And then when it comes to the diluted, when it comes to the fully diluted stake, I'm going to calculate all shares, including the stock options, okay? So this will be 1 million shares divided by 1.823, okay? So you can see that it's slightly lower. And this, so that's it. We've completed the first table. I went a bit quick, but I think it's pretty straightforward, right? These are the different stakes. Fully diluted, on a fully diluted basis, these are the stakes. On a non-fully diluted basis, the new investor is going to get 11% fully diluted, 11.1, okay? What happens in the new round? Basically, we do the same. We have calculated here, oh, we need to add this here. Okay, so the number of shares is now 3 point, no. No, the number of shares is 1.823, okay? And the share price in the late seed will be 4 million divided by the total shares before the round, pre-money, okay?
You still need to
yeah. Please ask questions. Yeah.
You still need to change it, because now when you put it into the right place in row 28, you need to recalculate row 22 on a fully diluted basis, because it's putting it on wrong numbers. It's screwing the entire.
Thank you. That's what you mean, right? Is that what you mean?
Yep.
Perfect. Thank you. Good. Good that you're following. I didn't do it on purpose to test you that you are awake. So now we go into the new round. This is the share price. So again, we calculate the number of shares. I think we can use the same formula. No. Okay. Now we have 342,000 shares. We calculate the total investment, which is that. And then everything else is calculated in exactly the same way. Okay. With the exception that this has to be moved here. So basically, the way I'm building this is basically adding different stages towards the right. And you may see that some information is repeated at every single stage, but that's much better than going into whatever round and having here references to cells that are in the beginning, if you know what I mean. So because the way of, the beauty of building it this way is that every chunk, every stage, every new round will only be linked to the one immediately before and not any one before, okay? Because if you link it to the one before and the one before and the one before, then at some point it's much easier to make mistakes, and these mistakes can be costly because okay. So now we have a convertible. Okay, now we have a different case. Okay, so in the convertible, I'm going to put it here because at some point it will convert. Okay, but before it has converted, there's no shares. That those investors don't have any shares. Okay, so the convertible is 1 million at a 20% discount and 8 million cap. For the sake of simplicity, I'm gonna assume that Beta Ventures is putting the entire million. The reality is that in every round, not one sole investor will take the entire round. It will be distributed among different investors. The calculations are relatively simple, and you can basically replicate these calculations for the other investors as well. Okay, but for the sake of speed, I'm going to assume that Beta is putting in 1 million. Okay. Now, the way we calculate the valuation here is with a discount and a cap based on the Series A valuation, right? Remember that the convertible will convert simultaneously to the Series A, right? So we said 20% discount, 8 million cap. Oops, one too many zeros. Okay, so the pre-money in this case will be calculated based on a 20% discount based on the other valuation. So the Series A, we said the Series A, I'm estimating the Series A to be at 12.5 million valuation. Okay. which means that the valuation of the convertible, so the loan of the convertible loan will convert in a number of shares based on a 20% discount on the 12.5 million pre-money or 8 million cap, which means that I put the smaller amount, I'm putting in a formula here, min, right? The smaller amount of applying this cap to this valuation, sorry, this discount to this valuation, or applying the 8 million cap. You see? So if the Series A is at 12 million, let's say the Series A is at 125 million, the convertible will still convert at 8 million because that's the cap. But if things don't go too well and you actually have a Series A at 7.5 million, the convertible will come in at a 20% discount at 6 million. Okay, that's how it works. Good. Post-money valuation. In this case, it would be. I mean, we don't need to calculate that, but let's calculate it. So in this case, it will be the pre-money plus the convertible. Sorry, the pre-money plus the money coming in. The number of shares we said before the convertible takes place, we had 2.165 million shares. So that's the number of shares. So the share price of the convertible will be 8 million divided by 2.1, okay? The Series A, we said we're gonna raise 4 million at 12.5. So Gamma Ventures is gonna give me 4 million. I keep putting too many zeros. The post-money valuation will be 12.5 plus 4 million. Okay, which means 16.5. How about the number of shares? Right?
Sorry to ask, shouldn't it be the post is the +4 + 1?
Sorry?
The convertibles are coming in at the former one. So the post-money value, they're coming in at the new series. So the post-money valuation does not suffer or does not get an advantage from that additional convertible loan. Because you put the post-money on the convertible loan before, but
yeah,
it has no value there. So
yeah, that's a very good point.
Be allocated to a post-money valuation here.
The reason why I don't include the convertible is because I'm only calculating the post money of this chunk. But if I am basically taking into account or communicating the entire round, the post money could be calculated as 12.5 plus 1 plus 4. You're right. But consider that in this case, the post money valuation I'm not using for any of the calculations. Okay, because the number of shares here. So the number of shares for the Series A investment is going to be based on the pre-money valuation that I'm using, exactly the same as before. The difference is that you always use the number of shares fully diluted after of the previous sort of round. In this particular case, the previous round to the Series A is not the convertible, is the late seed. So the number of shares you use in this calculation is exactly the same as the one used in the convertible. Okay, so I take 1.65. Okay, and the share price here will be calculated as 12.5 divided by 2.165. So the difference between this share price and this share price is still 20% discount. Okay, but you're absolutely right. This post-money valuation is related to just this chunk. But if I'm taking into account the entire round, the post money could be calculated as 12.5 plus 4 plus 1. Okay, and in fact, if I am calculating the number of shares, sorry, the share price based on the post money, then I would have to take into account that. But if I do that, because the post money, because the share prices are at different valuations, it can be a little bit tricky to calculate because you have to use the weightings basically. But
right.
it's a very good point. Yeah.
The discount here is much more than 20% because the cap kicked in.
Yeah, correct. Yeah, sorry. Yeah, you're right. So if yeah, exactly. If we were here 10 million, the cap wouldn't kick in, and then yeah, you're right. Yeah, absolutely. Good. So all the rest of the calculations here are pretty much the same. This is reference to the share price here. Okay. And so I'm just gonna finish this and illustrate the next point.
Uri, I can tell that you were an A student in school.
Good. It's good to ask questions and also correct me, because we all sometimes with Excel we always make mistakes, so it's always good to question everything. Okay, so I think this should be right? Yeah, so you can see the dilution here. We started with 55% almost on a fully diluted basis, and now we have gone to 41%. Sorry, 32% after the Series A. Okay. Now, one consideration here: imagine that before the sort of at this stage, I distributed some of those shares to a new hire, a CMO, for example, right? 45,000 stock options here. Okay, you can see that is coming out of the unallocated pool. So the number of stock options is not changing. Here I can add maybe somebody else, and then I hire a COO as well, and I give him 25,000. Okay, now, okay. So this should be this plus this minus some this. Okay. So the unallocated pool is reducing. So you come to the Series A with an unallocated pool of 5,000 stock options. Okay. That's very little, okay? So I guarantee you one of the discussions with a new investor is going to be, hey, you need to increase the pool, okay? We need to increase the stock option pool. Now, the question is, who pays for that? Shall we increase the pool after you come in? And the investor is going to tell you, no way, you increase the pool and then I come in. And if you have bargaining power, you're going to say, no. You're coming into the next round. You're bringing in the money for the next couple of years. I already paid for the cost of incentivizing management until now. If you're coming onto the new, if you're joining the journey now with me for the next few years, it's only fair that you also contribute to that. What that ultimately means is that if you allocate new stock options, for example, here, right, and the new shares, you increase the unallocated pool. Let me just first change the formula to make sure that it will still be working. And now you create here, let's say, another 150,000 stock options. So you increase the pool, the unallocated pool, to 4.7% on a fully diluted basis of the company. Okay, that's that's a pretty decent pool for a Series A. You may be required to do more. Let's see, 200,000. See what that means. If I'm doing it here, it means that it's basically done simultaneously to the round or after the round. So basically, this dilution of the 200,000 is going to affect everyone equally, including the new investor. You see. So if we were not putting in those 200,000, the stake will be 22.1. But if we increase the pool, he's going to be diluted by 15% or so. Okay, 15% or so, no, 12%. 22, no, less than that. Okay, so that is a point for discussion. Okay, and if we continue with this cap table, we will be basically adding a new round, a Series B, a 28 million pre-money, 10 million round, and you can see the dynamics. You will be building exactly the same into this stage. I'm not going to do it because we are running out of time, but that's how I would build the cap table. This is a plain vanilla cap table. It's very easy and simple. It gets a bit more complicated if at every single round there's new class of shares and you want to understand. And I do encourage you to calculate the number of shares for each class because of the voting implications, etc. You can basically add it here into new shares and total shares. So basically you split new shares and total shares in those classes. So you can see that the whole Excel is going to get bigger. But if you maintain it tidy and symmetrical and use color coding, it's going to be quite easy to understand and to follow. Okay, but again, this is not, this is down to each and everyone's style, so you can decide to do it differently. Okay. Now I'm going to show you a couple of more things. Let's go into this cap table, which is already done, which is even easier than the previous one. It's similar, but a bit easier. In fact, this one doesn't have any convertible. So we have an early seed, we have a late seed. No, actually, we do have a convertible, sorry. Okay, so this is the one. Sorry, this is exercise one. It's still the same one. I mean this one, exercise 2, okay? So this is, there's no convertible here. We have an early seed, a late seed, and a Series A at these valuations. And this is a very similar cap table in terms of structure and content, okay? There's nothing strange here. And what I want to show you is that based on this, then you can add the next layer, which is basically the waterfall. And I'm gonna show you what that looks like, okay? So this is, again, the same cap table with the different stages, the early seed, the late seed, and the Series A. But what we are doing here underneath is basically creating a waterfall of proceeds. Okay? So basically, at different exit scenarios, you can here build a cascading, you can basically build a waterfall of how the proceeds are going to be distributed. Now, this can get a little bit complex because you're going to have to consider things like liquidation preference here, okay? Let's look at an example, okay? If we look at this business angel round, the early seed, there is no liquidation preference there, okay? If we look at this other round, Alpha Ventures, which is a late seed round, there's still no liquidation preference. This is, by the way, quite standard. I mean, liquidation preferences are usually kicking in Series A and onwards. You can see them sometimes in before Series A, but it's not standard. It's not in every case. But if you're raising Series A money, it will most certainly be a part of the term sheet. When you are negotiating liquidation preferences, I urge you not to allow for participating liquidation preferences, okay? I'll explain you the difference. I assume you know the difference, but just in case, there is predominantly two types of liquidation preferences. participating and non-participating, okay? Non-participating is the good one, is the one you want. Is the one that is also called single dip. It's a liquidation preference is basically a downside protection for the investor, okay? And the downside protection kicks in when the valuation at exit is not very good, okay? And what it means is that, hey, I invest 1 million at 10 million valuation means I'm getting 10% of the company. But what happens if you sell the business for 5 million? Because things don't go well, etc. Well, in that case, I will want a liquidation preference of 1 time my investment. That's the standard. Meaning that no matter what, I have the right to get my money back first before anybody else gets money, okay? If you sell the business for 5 million, I get my 1 million, and then you do whatever you want with the proceeds. That's a non-participating liquidation preference. You only dip once. You either use the liquidation preference or you don't. In a participating one, you do both. You first get your money back or whatever liquidation preference you negotiated, 1x, 2x, 1.5, 3x. You know, we've heard all sorts of different numbers. The standard is 1x, okay? And that's, you should not accept normally more than that. So participating liquidation preference, 1 time my money, so I get my money back. And then from the rest of the proceeds, like everybody else, I get my pro rata, which means that if I own 10% of the company, I still get 10% of whatever is left. But first I get my million, okay? This is very dangerous because this is only 1 round. But if you have 1 round and then another one and then another one, and everybody is getting their liquidation preferences and people are getting participating liquidation preferences, and if you give a participating liquidation preference in an early round, the new investor may want that as well, right? So sometimes the rights are cumulative. It's very difficult to take away rights. And in fact, a lot of investors will want to get the same rights and improve them. Okay, so be careful, because if you're the founder and you may be buried under a whole range of layers of liquidation preferences, and there are instances where you may be selling the company for 50 million and you only get 500,000 for your own, for yourself, which is a disaster, right? So you need to be careful with that. The way it works, as I said, in low valuations, it kicks in. A non-participating one will not kick in if the valuation, the exit valuation, is above the investment valuation. Why? Because if I invested at 10 million, I invested 1 million at 10 million post money in exchange for 10%, and you sell the business for 50 million, I own 10% of the business. So if I don't use my liquidation preference, I will get 10% of 50 million, right? That's basically the calculation. And that's what's illustrated in this waterfall. And this is the easiest scenario that you can get, right? If you have different sort of investment rounds at different with different liquidation preferences, the last money coming in is usually the first investor being paid. So you need to take into account the order of who gets paid. On top of that, obviously, you need to take into account the stock options or phantom shares, etc. And that's how you calculate this sort of cascading of money until you get to the most important bit, which is how much am I getting as a founder, right? And then you can also calculate based on that the multipliers, right, for the investors. Investors invested, in this case, for example, if the exit was at 100 million, which is a great exit for this company that has, on which 201 million, 4.5 million were invested in this business, right? 250 plus 750 plus 3.5. So that's 4.5 million. And you set it by 10 million. So the business angel is going to multiply his investment by 28 times, which is not bad. Alpha Ventures is going to multiply by 16 times. Beta Ventures is going to multiply by 6 times, okay, based on this. if you sell the business at 3.5, which is a very bad valuation, because remember the last valuation was 12 million, right? You had, what's his name? Beta Ventures invest 3.5 million at 12 million valuation, but he negotiated a liquidation preference of one-time non-participating, which means that out of the 3.5 million, he's gonna get actually, this is correct, proceeds post LP 1.5.
You have 5 million on the top.
3.5 million, right? So, sorry, it says Index Ventures, but it should say Beta, okay? So Beta is gonna get 3.5 out of the 5 million. And the rest is 1.1. Why is it 1.1 here? 5 million Beta. Okay, so this is calculated as participating. This should be 0, okay? Because we said non-participating. So the proceeds left for the rest of the investors will be 1.5. And those 1.5 will be distributed pro rata to everyone except Beta Ventures, because they already applied the liquidation preference. If it's a participating liquidation preference, Beta will get 3.5, and then it will get the pro rata, which is 1.1, and the rest, which is, why is this not? Okay, I understand. So this will be what they would get. So you can see that out of the 1.5, Beta will still get 1.1. So it will be 400K distributed among everybody else, okay? That's why you don't want participating liquidation preferences. Okay, so let me just recap. I think we covered most of the stuff. So color coding, yes.
What about the other way around?
Sorry?
On the preemptive, it's very common that sometimes the investors negotiate to getting a multiple X on their investment and then participating on the pro rata. So when you have higher, if you have a certain amount of valuation, so for instance, on 100, they get 1. If it's 90 or 80, they get 2x, 3x.
Mm-hmm.
So that type of waterfall.
Yeah. So basically between non-participating and between a fully participating, you have intermediate scenarios similar to what you described. And this is to try to limit the extent of the participation, right? So basically, and those are not uncommon. Again, they're not standard, and you should try to push back on them. But if you need to, if you really need to accept a participating one, you should always put a limit. And that limit could be something like, as you said, I think that's what you were referring to, right? You can say, hey, it will be participating, but up until a certain multiple. Once you reach a certain multiple, there's no participation. And what that basically means is that you are guaranteeing not a 1x, but you may be guaranteeing a higher sort of return for the investor.
Not only, sometimes they double dip. So they would say, it doesn't matter why, because I risked at a certain stage to come inside. I want a 2x or a 3x on my investment, and only then it's pro rata. So that's why many times in investments, it's not necessarily the valuation that they entered which matters. It's what type of preemptive or restrictions or multiples that they put inside. They totally flip the entire picture. It only becomes, it doesn't matter if you have a 500 million or a unicorn type of exit. Absolutely.
In fact, yeah, I mean, I would deem some of those structures a little bit cheeky, especially at early stages, because one thing is to to protect somewhat your downside, but then on top of that, to guarantee a minimum return, it can be a little bit tricky in certain stages, but in other stages, based on the, depending on valuation and other types of terms, and I think you said it quite rightly, it's not always about valuation, it's also about the fine print as well of liquidation preference and other type of clauses. In the context of all, it may make sense sometimes. But if you're an early stage, seed, pre-seed, or even Series A, stay away from participating liquidation preference as much as you can. In fact, they're not market standard, so it's not the most common practice. Sometimes you'll be imposed to have those. Depending on your bargaining power, you may be able to push back or not. In other cases, and usually sort of in later stage cases, depending on the type of investor, it's an arrangement that could make total sense. So I'm not saying that you should always avoid them, but in some cases they do make sense. You just have to structure it accordingly. Private equities are very good with that, and in fact, when they invest in profitable companies, etc., it's very, very common to sort of include this type of arrangement and ratchet structures, etc., that guarantee a certain return for investors. Yeah. So I think we covered everything. The one thing that we haven't covered, and I'm not going to get into because it's quite complex, it's the anti-dilution, which is this mechanism whereby investors get the right to be compensated if you raise money at a lower valuation than the valuation at which I, as an investor, came in. This is pretty standard, but there's different ways to calculate that compensation, okay? I'm not gonna get into the details, but the main basic sort of ways are described here as broad-based weighted average formula, narrow-based weighted average formula, and full ratchet formula. What I would say is that at this stage, one thing you do have to remember is that this is the one that you want, which is the standard one, because it's more favorable to founders. Or if I say it, but actually I should rephrase that. This one is the one that is less punitive for founders, okay? Narrow-based is more punitive, and full ratchet formula is the worst, okay? I'm not gonna get into the dynamics and mechanics of this. I personally very infrequently had to calculate these numbers, but I do make sure that in every term sheet I negotiate, I go for the broad-based weighted average formula, okay? And I think so should you, if you can. And I'll leave it at that because we are already over time. I'm not sure if you have any time for a question or two, or.
I think if there's a last burning question, we can address it. I think I'll just use the opportunity to thank Unai for this. I think it's very, very practical and a great deep dive into how to build a cap table and what to do with it. There's a lot of terms, and I think it's been obviously, I've told the guys, a very heavy day on finance. But I think it's very, very useful to get into the deep end of it and calculate multiple scenarios of this cap table. So that you.
Are you sending us this formula table so we could play around with it?
Sorry?
Are you sending us this Excel formula so we could try to?
Yeah, I can send it to Vesela, and you can, you can get it.
It would help if it had already the formulas that you calculated inside, because it would help us reverse engineer if we're doing something wrong when trying to put that.
Not a problem, not a problem.
We're still amateurs.
That's fine.
You're a grade student. You have no problems with that.
Yeah, I'm still an amateur.
No, you're no amateur, Judith.
when I'll be in your seat, then I can say differently.
Yeah.
But always have other people look at this cap table. It's so important. And the mistakes will come up at some point. It's a question of when they come up. If they come up before you enter into negotiations or before you show numbers or put something in writing, that's fine. But if you base your whole negotiation and you start accepting terms and negotiating terms based on calculations that are wrong, you may be in a difficult position later on. So always have other people check it, etc.
All right, thank you guys. With this, we'll end it. Thank you, Unai.
Thank you.
For everybody else, watch for the newsletter on Thursday, and I'll see you next week.
Thank you. Thanks for your time. Bye.